Welcome everybody to another session of Toolkit Tuesday. I'm glad to see you guys here. Hope everybody had a great 4th of July weekend. In business, the most important thing that you can understand is numbers and your business's financial, reports and things. I mean, numbers is the language of business, and that's the only way that you'll know whether you're making good progress or not. So I'd like to introduce to you my colleague and great friend, Rhonda Jones. She is a business coach here at the Louisville Small Business Development Center. And have been getting tons of requests for help in understanding financial statements and how they relate to operating a business. And so Rhonda thought it'd be time to share a little bit about financial statements and how to read them. So welcome, Rhonda.
Dave, thank you for the introduction.
Yeah.
Excited to be here.
And if you wouldn't mind, everyone, if you just hover down towards the bottom of your screen, a little toolbar will come up if it's not there already. And there you'll find the chat feature. If you just click on chat, and just to make sure you can hear us and that we know that everything's working correctly, you can see us. Just go ahead and say hello and tell us where you're joining from. It's always great to see where people pop in from. We get people from all over the country sometimes the world. So it's really interesting to see that. And then as we go through the information today, just go ahead and if you have any questions or comments for Rhonda, just put them in the chat. I'll keep an eye on that, and I'll try to answer in the chat if I can. If not, we'll throw them right out to Rhonda, and she'll jump in and take care of that as well. So Rhonda, with that, I'm just going to toss it to you, and let's just get started and dig into some financial statements for our small businesses.
Thank you, Dave. Welcome to Understanding Financial Statements. So, as a business owner, you might say, what do I need to know about financial statements? Well, let's see. So today we're going to review the overview of financial statements, ways to analyze your numbers, discussion of cash, and manage scorecards and other tips. And this is just a graph that we put together from our research that businesses that keep good records and understand their financial statements have a higher survival rate. So as you can see, it's good. Over on the column says good. 80% of the businesses started. As the graph descends to poor, these business owners do not monitor or understand what's going on with their financial statements. So in order to have a good survival rate and increase your chances of being successful, it's very important that you learn to understand your financial statements and monitor those and use those statements for success. So why keep records? For one thing, it's the law. The IRS, our government and state, require that we keep good records, because when we file our taxes and we have our CPA file our tax returns, that we have to have proper documentation, receipts, and ways of showing that we are innocent before proving guilty, that we are really do what we say we do, and that we pay what we're supposed to pay. So it's very important to keep those receipts, keep those documents, keep good records, so your CPA can file an accurate tax return for you. And another reason why we need to keep good records is because when you go to a bank or lender or an investor to obtain financing, you want to make sure that you are able to supply the information they need to make a decision. So it gives the lender and the investors power to make better decisions when they can see your past records and receipts and performances. So you want to make sure that when you present your financial statements, that you can also discuss those financial statements with the bankers. And we need to be able to issue 1099s to vendors and W-2s. And so we have to have records in order to do those properly. And also track who you owe and who owes you, especially who owes you. You want to make sure you're collecting And also you do want to pay your debts. And by understanding your financial statements, you are able to monitor business trends, which helps you make better decisions moving forward as far as, what do you sell more? Do you need to increase your pricing? And do you need to stop or maybe start a new product or service? So I know talking to a lot of business owners, sometimes they're guilty of commingling their personal funds. So you want to have a separate checking account. Do not commingle your funds with your business account. It's just really confusing and it just creates a mess. You will have a separate credit card. It makes life much easier filing your taxes. And you want your electronic receipts and papers too, but you want to keep your paper and your electronic receipts available. Because as I mentioned before, you may have to prove your innocence to the IRS, to our government. So it's very important to keep your business and your personal records separate. So record keeping methods. So you can do one or the other. You can purchase an accounting software, something like QuickBooks or Peachtree, which these are so helpful to small business owners. They have a ledger. You're able to write checks from these accounting services. They've made them so easy to use now. You print out checks or whatever you need, even keep up with inventory if you have a really good accounting software. They're very inexpensive, but I'm telling you, they are worth the money. It keeps you in compliant, and you're able to produce those records when you need those records to present to your CPA or for an audit. So either you want a good accounting software system or you want to do it manually, which back us like the Stone Ages, when you have a general ledger book, check register, and bank statements. Those are good, but you also want to have accounting software, but you do not want a shoebox receipt method. So to invest in a really good accounting software, it will save you money, save a lot of headaches, keep your business running smoothly, and keep you out of trouble. So benefits of financial statements. As we mentioned before, it helps you monitor your business activities, what's going on in your business, what's trending, understand the financial outlook. How are you coming along as far as reaching your financial goals? Are you keeping your profit margins where you want them to be? It maximizes profit-driven activities. It tells you what you should do more of or less of. It also identifies problem areas that you may have. And so it could help you also decide on solutions for those problems by knowing how to monitor and review your financial statements. And again, as we mentioned before, it provides vital information to partners, to banks, and investors. And most importantly, I think it helps you plan for the future. So what are financial statements? Well, there are three major types that we normally use when we are working on our financial projections and helping a business get started or expand. And the first one is the balance sheet, the income statement or profit and loss. Some people call it profit and loss. I call it the results statement sometimes because it shows you the results of your business. Are you making a profit or loss? What's going on? And a statement of cash flow. So how is your cash flowing in and out of your business? Is it positive or negative? So the balance sheet, it's called a balance sheet for a reason, guys. It has to balance. And so it's a statement at a point of time. It's like a snapshot right then. And it's going to list all your assets. What does your company own? It could be in cash, inventory, equipment, land, buildings, furniture and fixtures, so many things that you will have listed as your assets. What do you owe? accounts payable, people you haven't paid yet, loans, different debt. And also you're going to have on your balance sheet, owner's equity, capital investment, retained earnings. Profits will be in here. What, what the owner is, what you as owner are investing into your business. So as I said before, it has to balance out your assets. It has to equal your liabilities and your equity. Right. So what your business owns, what your business owns will equal what your business owes and your owner's equity. And we'll show you how that works. So the financial equation, assets equals liabilities and equity. So there are two ways you can have assets, two sources. Okay, so there's debt financing, vendors, credit, loans from banks, owner's equity, retained earnings, which we mentioned before, business profits, and money you have invested as an owner. So these assets have to equal liabilities and equity. And we would build a balance sheet later on in the presentation together. Okay, this is just a sample balance sheet so you can see. As you see the left-hand column, there are your assets. This particular business owns $550 in cash, 300 accounts receivables, $450 in inventory, office equipment, and then there's some depreciation on this office equipment. Because of course, the longer you have a piece of equipment, the less it's gonna, it's gonna devalue. It's not gonna be as valued as much 3 or 4 years down the road. And so we get your total equipment, which is $200. And then deposit, utility deposit, and this column is gonna equal $1,600. So let's see. The right-hand column, we want that to equal the left-hand column. And so we have accounts payable of $400 that we have to pay, credit card debt, which is $50, liabilities, your liabilities totaling $450. As the owner, you have invested $1,000 and you got your retained earnings, $150, which comes up to $1,150. But if we add the owner's equity with the total liabilities, as you'll see, this particular balance sheet actually balances. So it's $1,600 balances out. If it doesn't, we need to go back and see what's wrong. Something's off. Okay. And the next statement we're going to talk about is the income statement. It's a statement covering a period of time. Like I said before, I call it the result statement. What are the results? And so, okay, so you may sell shoes, for example. So your company sells shoes. Okay, but you may sell your shoes $50 a piece. But you had to buy those shoes. So maybe it costs you $25. That'd be part of your cost of goods. So, or if you're making your items, then you have to pay for materials, labor, and overhead. And then you're going to have your operating expenses, your daily operating expenses. And that's when you'll have your net income. And so if someone said, well, how, what's your profit margin? What are you profiting? What's your cost of goods sold? You should be able to know what statement to go to, your income statement or your result statement. Here's a sample income statement for you to review. Okay, so our sales are $500, but you know what? It costs us $150 to make that $500. So my gross profit is $350. But I also have operating expenses I have to pay. Insurances, marketing expense, professional services, utilities, whatever it may be. And it totaled $150. But remember, we have that equipment and it depreciates. That is an expense. So we have to include that. And so our total expenses for this particular business example is $200. Okay, so we're going to subtract the total expenses from the gross profit. And so our earnings before tax is $150. Okay, so we talked about also a little bit about the cash flow statement. This is a statement covering a period of time. How's the cash flowing in and out of your business? How healthy is your business? And this is what a lot of bankers will look at. Let's see what your cash flow statement is. Are you losing cash? Or is it a positive ending cash balance? So in this particular statement, you're going to have your cash receipts, sales that you made, that you received cash for, customer payments, loans proceeds. This is what you are receiving. And then what's going out are your cash payments. You purchase inventory, you pay for your expenses, and you're paying for wages. So you're going to have a beginning and ending cash balance. Here's a symbol. So we didn't have any cash in the beginning, but you invested $1,000. And so you had $200 in sales. So your total receipts for this particular statement is $1,200. But you also had to make payments. You made deposits for utilities, payments of expenses. You made some debt payments as well. Totaling $650. So if we subtract those total receipts, money coming in, our cash coming in from the cash flowing out, then our cash flow for that period is $550. It's positive. So we have an ending cash of $550. So this is a healthy cash flow statement, a healthy business at this moment, at this particular time. So what is the difference, profit versus cash? We talked about the income statement. So we're just going to build one. We can just kind of go over what goes into the income statement. We're going to build one. We're going to put numbers in. So like we said, income statement, profit and loss, result statement, whatever you want to call it. We know that if we want to see how much sales we have accomplished, we know to look at the income statement. So we know we have made sales, but also cash sales and accrued sales. Okay, these are sales that we have not actually got paid for yet, but we count those in income statement. So income statement, sales, cash plus accrued sales, less cost of sales, cost of the sales. So what did it cost us? What did it cost us to make these sales? We talked about that, cost of goods sold. And so we're going to have the cost of sales, the cash expense, and accrued expense. We keep those separate, okay? So we still put in our income statement. We got our sales, we got our cash sales, accrued sales. We haven't got paid on those yet. Costs, what did it cost us? Our cash expenses, our accrued expenses, but we haven't paid yet. Maybe we haven't received the invoice for it yet. But we always have to remember that depreciation expense. So we're going to have that. And we know in order to get our net profit before taxes, we know what we have to have on our income statement. Our cash, the cost of our cash our sales coming in, what it costs us for the sales, and any depreciation. And we're just going to assume a 35% tax bracket for this particular business. So we have to pay Uncle Sam, of course. And then once we get all these numbers in, we will see a net operating profit after tax. So let's put in some numbers. Just play with this a little bit. Okay, so we had $200 in sales. But it cost us $70 to make that $200. Well, we ended up spending $10 for depreciation. So here we go. That's our net profit. So I'm asking you as a business owner, I said, what is your net profit before taxes? You don't, so how do I find that? You're gonna know. Well, I know that I have to go to my income statement. Because I know I need to know this information to be a successful business owner. I know I have to keep up with this. I need to know what's my net profit before taxes and after taxes. So we're assuming a 35% tax bracket there, and we put $42. And so, okay, great. So we know what our net profit is before we pay taxes, but what is it after tax? And it's $78. So this is simple enough where you can build your own income statement. If you just, playing around with it, of course, you don't want to keep your own books or whatever, but you need to understand before you open your business, how these statements, and of course, when you run your business, how these numbers are going to come about. You should be able to come up with these numbers yourself, even though we help you with that at the Small Business Development Center, but these are your numbers. Okay, here we are. So we had $200 in sales again, $70 cost of sales, that's depreciation, net profit before taxes, 35% percentage on net profit. So we're going to build a cash. So right there, as it shows you the cash, this net profit before sales includes cash and accrued profit as well. Okay. So we're paying, that's the net profit. And so from this income statement, we'll be able to build a cash statement to see how our cash is flowing in and out, because it's not necessarily, this is not the same. So we're going to start building that and see how we come up with that. And so these are the items that are on the cash statement, the cash flow statement. So it's going to be cash from operations, cash plus paid on accounts, what you've paid, less cash expenses and cash payments to accrued expenses you have not paid yet. And we're going to put our taxes right after the cash that we're receiving and cash that's going out, because we know we have to pay our taxes, and it's going to show us the cash from operations. And the cash, we'll see the cash going out and coming in from financing activities. And it'll show us if we have free cash flow or not, how strong our company is or isn't. So let's build one. So we got our cash from our cash sales, but we paid on the account. We paid $10 on the account, so we have $190. And we know that over here on the left-hand column, the cost of sales and cash expenses and accrued expenses is $70. So we have to add that $10 to the 70, which brings us to $80. So we have to deduct $80 from the cash we received and what we paid on cash. Okay, so we're going to pay our taxes there, $42. And that's where we got it from. So we take our taxes that's on the income statement, and that's how we transfer it over to our cash flow statement. It has to be included. So cash from operations, so cash in and out from financing activities is $27. So you see how the numbers are adding up. So from the beginning, we started out with $190 because we paid $10 on we paid on an account. We have our cost of sales. It costs us $70 to make it $200. We added that to the $10, which is $80. We included our taxes. We got that from our income statement. And so if we calculate those numbers, we come up with cash from operations. And then we include our cash in and out from financing activities. And let's see where we are. So we have a free cash flow of $41. So it's a positive cash flow, which this is what we want to happen. So you can do this even for yourself. If you know how to build your income statement properly, and you want to see how your cash is flowing in and out, you can just take these particular line items and see whether or not you have a positive cash flow. So here we are, side by side. This is what we built together. We have an income statement and a cash statement. As you can see, this is the same line items in both of these statements. basically. They're different a little bit, but they're basically the same. But it tells us it gives us a different result as the cash statement shows us how the cash is flowing in and out. The income statement is basically showing us our profit before taxes and our net profit after tax. Okay, so there are two types of accounting systems, the cash basis accounting. These transactions are recorded when cash moves. So you get cash, it's recorded right away, of course, and expenses at the time of bill. These are cash transactions. The accrual basis accounting is you record these as they occur. So, you may make a sale, but you may not receive the funds right away. Or you may have an expense. You may not have received the invoice right away, but you can use either one of these accounting systems. So now that you basically know how your cash flow works, your income statement, balance sheet, what good are these numbers? How do you analyze your numbers? So if you're going to have these financial statements, you want to put them to use. You want to see, where'd your money come from, where your money's going, and where is it right now. So you want to track where your company money goes. This helps you determine which products or services are profitable. So as you review your financial statements, and you're going to have your profit centers listed on your financial statements. You have your profit centers listed on your income statement, because if you sell different items, you'll have a different cost of goods sold for each one. So say you sell shoes and dresses. Your shoes may cost you 25%. It may be your 25% may be your cost of goods sold, and your dresses may be 50% of your cost of goods sold. And as you look at your financial statements, and you can see which products or services are generating the revenue for your company. And if these products are being sold more at different times of the year or less, or if they're seasonal. So these financial statements tell you a lot, which you can adjust and change your direction when you see what's profitable by knowing how to read your financial statements. You don't want to just depend on your CPA or accountant. You want to be able to count your own money, monitor where your business is going, and be knowledgeable. Not an expert, just need to know the basics and know what to look for. And it will tell you if you're charging enough. And it will compare your actual results to what you planned. You say, hey, I plan on making $200,000 my first year. That's great. Or you look at see if you're on target, if you're on track to make those results happen. And if not, what do you have to do to make those results happen? How many more units do you need to sell? How many, do you need to adjust your cost of goods sold, or you need to look around for different suppliers? So these financial statements can be used to really help your business be successful and continue to grow. So actual versus plan. So you want to prepare a business plan. A lot of people want to skip this step, but if you start right, you'll end right. If you start smart, most likely your chances of success will increase. So you want to take the time to write your business plan, and we will assist you with writing your business plan in the Small Business Development Center. And you want to make sure you have all the important information that's needed for you to know where you're going. Also, if you're trying to get funding, that the lender or investor actually can see that you have a solid plan, you thought it out, is detailed, and important information is included in your business plan. And of course, along with the business plan, you have your projections, your financial results. You have your projections. You're going to project how much income your business will generate by creating your income statement, your cash flow statement, and your balance sheet. But you're also going to have, assumptions to support those projections. You're gonna, tell how many, as like I said, maybe earlier, like how many units you need to make that $200,000. And most importantly, how you're gonna sell those units. What is your marketing strategy? And then it helps you budget your expenses. And you gotta know your break even. So your break even is actually how many units or how many sales or how many services you have to provide to pay all your costs before you make a dollar. So, if your costs are $50,000, at what point of your business, what month are you projecting that you will make enough that all your costs will be met? And then you'll start making your profit from there. So you want to know that. So that's really important that you know your break-even point. And so you want to compare your financial statements to your business plan. You want to make sure they're in alignment with each other. You don't want your business plan to say one thing and your financials saying another. So you want to monitor your spending. So if you're saying, this is what you're going to do, your business plan saying is making or predicting or making these statements, then your financials should, go along with your business plan. So you will have a dose of reality. Just know, be realistic. And then you want to determine any cause of variance. What can happen to, so if things are not exactly like you want them, things can happen in your industry or, in your life, or anything can happen. So you want to determine the cause of any variances that cause your plan not to be on track, on target for what you said it would be. So sometimes, suppliers or go out of business, or people may resign, or whatever caused your plan not to be in alignment. You want to be able to determine that. Then take action, execute. So you want to get behind the numbers. So some basic tools, you want to do comparison, ratios, we set break-even point, and also critical indicators. So comparison. So financial results should never stand alone. You want to compare your assets and liabilities to the prior year if you are an existing business. So if you're in your second year, look back. How are you doing? Are you getting better? Are you losing money? Are you bleeding out? You want to be familiar or compare year to year. You want to compare your profit and loss to plan and or the same period last year. So like we had mentioned, sometimes your business could be seasonal. So maybe you made, a little bit more money the second year, but you want to see if the money was made at the same level in different periods of the year. So you want to make sure you compare and see, because you might have to make an adjustment. So you really need to know the numbers. So showing trailing 12 months activity on one page so you can see. It's easy to, if you have, have like a whole year on one page, month to month, it's easy to see the trends, opposed to it just being like one total for the year. So you want to have a 12-month activities on one page, so it's easy to see. And it avoids, it's that time of the year delusion. So you want to just really look at the facts. This is just an example of a profit and loss statement that we do here at the Small Business Development Center. As you can see, we have our revenue, our cost of goods sold, our gross profit, and then we list all those expenses we were talking about. And then over to the right, you can see we have different ratios. And so these are indicators, and we can kind of see, if things are trending, and we can use this year compared to year two. So these are some financial figures that tells you a little bit more that we can look at together. So they're called financial ratios. So you have debt to equity ratio, current ratio, return on equity, inventory turnover, days sales outstanding. Now, depending on your industry or your business, some of these ratios may not be applicable to your business. So you just use the ones that will fit your particular industry or business. Okay, so debt equity ratio measures how the business is financed. So when a ratio is like 1-to-1, it means that there are equal amounts of debt and equity. Rule of thumb, 1-to-1 is okay. So we have to see whether or not that your debt can be paid with the dollars that you are generating. So the debt to equity ratio is a good one to use. So when the debt is higher, business is highly leveraged, borrowing power is limited, and interest expense is high. So if every dollar you make, you have $1 to pay your debt. That's acceptable. Then you look at your current assets expected to be converted to cash within 1 year, and your current liabilities expected to be paid within 1 year. When we say current, we mean within 1 year. So just have this a little short example. In the example company's sum of cash, accounts receivable, and inventory, I think it was negative $70,000 compared to the sum of accounts payable, short-term debt, which is $28,000. So it equals current ratio will be 2.5-to-1, might be too good. So you maybe not need financing. But a ratio of 2-to-1 indicates current assets are twice the current liabilities. So current assets are twice the current liabilities, probably able to handle obligations that come in. So that's what you want to remember. Okay, so and ratios is so also depending if you keep inventory, you might just have service, but inventory turnover measures how well your products your products on hand are selling. Inventory compared to cost of sales equals inventory turnover. In the example, inventory at 5/31 is 30,000. Cost of sales for 5 months is 30,000. 12 months is 72,000. Inventory turnover is 2.4. So just look at the standard for your particular industry as well. So standards for inventory turnover vary by the type of business, but 2.4 times is poor for any business. So you want to make sure you keep on top of how your inventory is turning over. And of course, we can use our financial statements to determine how fast or how slow they are turning over. So days sales outstanding measures the quality of accounts receivable. And the example company, accounts receivable 5/31 is 20,000, sales for 5 months is 50,000. And this year, 5-month sales represent 105 work days. So sales per day is 476. Accounts receivable is 20,000 equals 42 days outstanding. So in terms of sales, our 30 days net, collections are a bit slow, but not too bad. So you don't want to get into, like 60 days. And this is just what we had talked about earlier. You can use this as a comparison 2 years ago, last year, and current. You can just look at your gross profit margin, your profit margin on sales, return on total assets, return of equity, return on investment. And then look at your gross profit sales, your net profit after tax sales, net profit after tax total assets, net profit after taxes, stockholders' equity, net profit after taxes, total assets. You want to look at these categories and compare them from year to year. So what are some critical indicators? So not all management information comes from accounting systems. There are indicators that will tell you how you are doing on a daily or weekly basis. They are usually specific to your particular business. So some examples are units sold, billable hours, maybe if you're an attorney or something, or backlog of unfilled orders. If you're selling, something online and just backlog, or how many meals are served. So comparisons can be very useful and help you make a decision on whether to continue what you're doing or modify some things that you're doing. So if you can think of any others, write those down. So what is cash flow? this is what we wish it, this is cash flow. I wish cash flow would just flow to me like this, but it's not happening, but I wish. So why is it so hard to manage cash? We're growing and profitable, but where's the money? Where's the money? She doesn't know where to look. She doesn't know her financial statements. Where is the money? So cash versus profit. So profit is defined by the rules of accounting. As we spoke about earlier, sales minus expense, that's your profit, which we'll find that on the income statement. Cash in, cash out equals cash flow, which we talked about on our cash flow statement. So what creates cash? Actually collecting on that invoice. If I can just get one more sale, I can make it happen. So growing your business puts a huge strain on cash. We have to buy additional inventory, maybe hire a new person for your staff. You have to invest in materials and labor, equipment before that sale, before you really can, generate that additional income. You might need a particular piece of equipment or update a piece of an equipment, but you're growing broke. So where does it come from and where does it go? That's what we want to know. Operating expense and non-operating expense. So cash flow, where does it come from? Where does it go? The sources of cash. As we saw on our income statement, we saw cash and credit card sales, accounts receivables, and on our operating, how we use the cash from the operating income, we saw that it's going to pay for salaries and wages, to purchase materials, your overhead expense, marketing and advertising, administrative expense. All these things have to be paid, taxes. And then we have our non-operating, which is going to be assets, the equipment that we have, inventory, liquidation, loans, debt, credit card, borrowing, cash contributions, move from owners, cash purchases by new owners. And our non-operating asset purchase, cash only, accounts payable, loan debt, and credit card principal payments. Cash draws to owners, not salary. So sometimes the owner can do a cash withdrawal. So we got our sources of cash, and we have what are we using these cash? What are we using the cash for? For operating, non-operating, sources of cash, operating and non-operating. This is what you want to keep separate. You want to know how they work together. So in order to process our cash flow management, you have to set cash goals. It's very important to develop a budget, and it's important to know how to forecast and report and analyze our results. Why, what are we doing good? What are we doing bad? How can we change? And you can make those decisions if you know your financial statements, if you just understand them. The process of cash flow, set goals, develop a budget, forecast cash, report, analyze results. And then maybe some type of emergency fund or miscellaneous expenses you might want to have a budget for, and determine your minimal balances. And it really have to be good at managing your accounts receivable, because you can make a lot of sales and if you're not receiving the money for those invoices you're sending out, it can really hurt your business. So you have to have a system in place where you know how to manage those, or hire someone to manage your accounts receivable. But that's really very important. In the process of the cash flow management, again, we said set cash goals, develop a budget, forecast, and report and analyze results. And again, this process of cash flow management is develop a budget. So we kind of broke it down, forecast cash, report, and analyze results. It's kind of repeating itself here. So quick budgeting tips. So even though you may have a great software system in place, which is good, highly recommend that. But also you want to look at your bank statements, either in your system or a paper bank statement, and just see, kind of know where your money's going, how's it flowing. make conservative revenue assumptions. So I tell my clients that when, we're making these assumptions, we don't want to be unrealistic. We want to be, make sure we are conservative in what's going on in the industry, what's going on in your particular business, your competitors, and use, we said use industry benchmarks, and you want to use a spreadsheet. So you can see it right in front of you, a whole year, 12 months, use a spreadsheet. So if I just some slack in there. So, sometimes depending on what business you're in, there might be a little slack there where the sales might be slow. There's, particular times and others, so you have to know that, so you can factor that in and look to cut costs. It might be a great time to shop with suppliers. If you have a supplier and, and if you want to cut costs, you might want to see if you can negotiate a new contract or a new price. Those suppliers, or look around and shop for other suppliers to keep yourself within that budget. So a budget forecast and plan sales, expense, and profit. These are important things to consider. Did that. So report and analyze results, flash report. Facts at a glance on one page. We talked about that. Status and trends of key numbers. Talked about that. Part of the company's rhythm has the business, going and rolling, and make it work for you. There's no right way. Make it work for you. And then you have right here a scorecard you can keep up with just for yourself. A weekly scorecard. You can, when you set your goals, you can kind of just, you're trying to really keep up with things, especially if you're a new business, no matter how old or new you are, really. You just want to kind of have a scorecard where you have already set goals and you know what you want to obtain. And so you want to just monitor these particular categories weekly and make notes. So some final thoughts. Ignore important information at your peril. Don't assume, calculate. Don't make us, you want to calculate risk. A gut feeling is not a unit of measure. Will we be able to have access to this information? Dave, think we can get this out to the attendees?
Yeah, absolutely. So later on today, you'll receive an email from us, and we'll have the replay as well as the slides. You can always reach out to us, and then if you need any help, I'm going to put Rhonda's contact info in the chat for you guys if you would like.
I have it up on the screen, Dave.
Oh yeah, there we go. Sorry, I had it covered up. There we go. So yeah, just reach out to Rhonda. You can schedule a meeting with Rhonda there with the lower link, thecalendly.com/Rhonda Jones. That's the easiest way to get a hold of us. So if you have any questions, go ahead and put them in the chat while we have a couple of minutes. And hey, Sabira. Sabira gave you thumbs up and a nice clapping hands. She says, great job. This is very important stuff. So thank you, Rhonda.
Thank you.
So let's see. I don't see any other questions.
We have 9 minutes left. I don't know if anyone had any questions.
Don't see anything else. So Sakina says, this was phenomenal as I'm starting a new leg in my new business. I really needed this. So good. Yeah. So Rhonda, any other last words you want to add on? And any last minute tips and tricks?
Well, I think that starting a business is exciting venture, but also it's risky. But when you look at the numbers and you know the information, you know your competitors, you know what's going on in the industry, it all makes sense. The dots are all connecting. I think you should go for it.
Mhm.
If you have a dream you should go for your dream. And if your goal is to leave a legacy for your family and you want to help impact the economy by creating jobs and just calling your own shots, I would definitely reach out to the Small Business Development Center. That's what we do. We help businesses launch. We help them get started. We help you with your business plan and your financial projections. And we help you with really important industry information. And we hold your hand from the time you write your first word on your business plan till you open your doors and have your ribbon cutting. So small business is very important to us and to everyone. And so I just want to encourage you to reach out to the Small Business Development Center and let us help you realize your dream.
So Rhonda Sakina, I hope I'm pronouncing that right, and I apologize if I'm not. She wants to know, is there a fee for this?
No, our services are no cost to you. Our services are supported by taxpayers' money. The SBA supports us and the University of Kentucky. And so we are, servants for the community. We don't charge for our services. And so that's why it's so awesome for you to take advantage of this awesome opportunity, this awesome resource for you.
Thank you. Okay, that looks like we've got it. She says, thank you for that.
Welcome.
Well, Rhonda, you did a great job today. This was really fantastic stuff. I really appreciate this. And I hope we'll do this again very soon. It sounds like everybody really wanted to see this and really needed it. So thank you again, Rhonda.
Well, you're so welcome. I hope so. I hope they were able to understand the three major financial statements and how they work.
Yeah. So yeah, Kenya says she needs a business coach. So reach out to us. We'd be happy to help. So, well, thanks for joining us for another Toolkit Tuesday. Oh, wait a minute. Sabira says, Rhonda, what is the time frame the business clients can expect for this process to take place from start to finish?
Well, it's up to the client. The ball's always in your court. We are here for you. So I have clients come in and they, meet with me once a week or once every 2 weeks, this depends on your schedule and your urgency. So if you set a goal, I want my business plan done in 2 weeks or 4 weeks, that's what we shoot for. Or you just maybe a couple of months. So really you set your own time frame. But normally a business plan, you're going to really invest maybe 30 to 40 hours in a business plan and financial projections. And then if you want to go for a loan, it may take 6 to 8 weeks before you get funded. So it depends on you, your urgency, how committed you are, how serious you are, and you stay in focus. So if you're a serious client, remember the squeaky wheel always gets oiled. So it's up to you.
Definitely. Okay. All right, that looks like it. Okay. Well, thank you guys so much for joining us for another Toolkit Tuesday. And Rhonda, thank you for a great presentation and taking time out of your busy day to share with everyone. And
thank you for allowing me to speak today, Dave. Appreciate it.
And we'll be back next week.